Hey everyone, and welcome back to The Explainer. I am absolutely thrilled to have you here today because we're going to unlock something truly fundamental. We are going to master the logical balancing act of accounting. If you ever looked at a financial statement and felt like it was written in some sort of secret code, or if you're an exam candidate and you're just feeling totally overwhelmed by debits and credits, well, you are in the exact right place. We're going to break down this complex system step by step, making these concepts just completely click for you. So get ready to transform from feeling maybe a little confused to completely confident.
Here's a quick look at our roadmap for today. We'll start off with the double entry system, jump into the accounting equation, cover the 3 types of accounts, and then reveal the golden rules of accounting. After that, we'll get practical with recording journal entries, and finally wrap the whole thing up with a recap and some crucial exam tips.
Okay, Section 1, the double entry system. Let's dive right into this and look at where modern accounting actually came from.
Now, what's really wild is that accounting isn't just some modern corporate invention. No way. The double entry system is actually more than 500 years old. Back in 1494, an Italian mathematician, a friar named Luca Pacioli, published a book called Summa de Arithmetica, which was basically everything about arithmetic and geometry at the time. And right there in those pages, he described the very first double-entry accounting system. Fast forward to the modern day, and it's evolved into literally the only scientific system of accounting used globally. It's the universal language of business.
So what is it exactly? Well, the double entry system is a system which recognizes and records both aspects of transactions. Think of it as the fundamental law of finance. Every single transaction has a twofold aspect. It's a give and a take. For example, say you buy some shiny new furniture for your business using cash. On one hand, you get a new asset, the furniture. But on the other hand, your cash balance goes down. You literally can't have one without the other, right? This system perfectly captures that reality by recording both ends of the event.
So the absolute most crucial point here is the number 2. Because of this dual aspect, every single transaction affects at least 2 accounts. One account will always going to be debited, and another account will always be credited. If you ever find yourself recording a business event and you've only touched one account, stop right there. You've missed half the story.
All right, moving on to Section 2, the accounting equation. Let's see how that twofold aspect builds into the mathematical formula that proves why this whole system actually works. This brilliantly illustrates the absolute core foundation of accounting. Total assets equals liabilities plus owner's capital. Seriously, if you're taking notes, burn this equation into your memory. Assets are the things the business actually owns, like cash, inventory, or machinery. The right side of the equation tells us exactly how the business paid for all those things. They either borrowed money, which creates a liability, or the owner invested their own money, which is owner's capital. The left side must always perfectly, unequivocally balance with the right side.
Let's walk through a real-world example to really visualize this. Imagine an owner starts a business by putting in 10 lakh rupees in cash. Under assets, our cash goes up by 10 lakh. On the flip side, owner's capital goes up by 10 lakh. It perfectly balances. Now, let's say the business borrows 5 lakh rupees from a bank. Our cash asset increases by another 5 lakh, but simultaneously, a liability of 5 lakh is created. If you add it all up, we have 15 lakh in assets, which perfectly equals 5 lakh in liabilities plus 10 lakh in capital. No matter what crazy transaction happens, this equation will always hold true.
Right. On to Section 3, the 3 types of accounts. Now that we understand the basic equation, let's meet the cast of characters in our accounting story. We can classify all accounts into 3 main buckets. Let's compare the first 2, personal versus real accounts. Personal accounts are exactly what they sound like. They relate to persons. But keep in mind, this includes natural humans, artificial legal entities like a corporation or a bank, and even representative personal accounts like outstanding rent owed to a landlord. Real accounts, on the other hand, are the accounts of things you can generally touch or see. These are your assets, your cash, your land, buildings, and that furniture we talked about. Those are all classified as real accounts.
And the third character in our story is the nominal account. By definition, these are accounts where information relating to a particular income, expense, loss, or gain is recorded. While real accounts track what you own, nominal accounts track your daily ongoing operations. It's keeping the lights on. Think of paying salaries, paying rent, earning sales revenue, or giving a customer a discount. These don't represent a physical asset or a person. They're just tracking the flow of wealth coming in and going out over a specific period of time.
Okay, Section 4, the golden rules of accounting. We are now moving to the strict laws that govern exactly how these 3 types of accounts interact.
Now, you might be wondering,
This is all great, but how do we know exactly what to debit and what to credit when a transaction actually happens? You know it affects two accounts, but which one gets the debit? You can't just guess. Well, behold the ultimate exam cheat sheet, the golden rules of accounting. I highly recommend pausing and memorizing these rules because they are absolutely key to passing any accounting exam. Here's how it works. If the account involved is a personal account, you debit the receiver and credit the giver. If it is a real account, an asset, you debit what comes into the business and you credit what goes out. And finally, if it's a nominal account tracking your operations, you debit all expenses and losses and you credit all incomes and gains. Every single transaction you ever record follows these three simple rules. A great memory trick is this. Personal accounts are people giving and receiving gifts. Real accounts are physical objects coming in and out of a door. And nominal accounts are just names on a bill, expenses you pay or income you receive. Actually, before we go any further, I need to explicitly warn you about a massive trap. Debit and credit do not mean favorable or unfavorable. They do not mean good or bad. Seriously, so many students lose marks because they think a debit is a bad thing like a bank fee, or a credit is a good thing because of credit cards. In accounting, debit literally just means the left side of an account, and credit just means the right side. That is the whole shebang. Whether it is good or bad for the business depends entirely on what kind of account we are talking about.
Section 5. Recording journal entries. Let's shift our focus to how we actually write all these transactions down in the real world. We use a format called a journal, which is the book of original entry, and it has to contain 5 specific columns. First is the date, and you write that strictly as year, then month, then day. Second is the particulars column, which is where we name the actual accounts we are debiting and crediting. Third is the ledger folio, or LF. This is literally just a page number referencing where this account lives in the main ledger. Honestly, you usually just leave this blank on exams. And finally, 2 amount columns, one for the debit amount and one for the credit amount.
Now, formatting that particulars column correctly is absolutely vital. Step 1. You always write the account to be debited first, and you add the letters DR at the very end of that line. Step 2. On the very next line, you leave a little space, like an indent, and write the word to followed by the name of the account to be credited. Step 3. On the third line, you write a brief explanation in parentheses, something like, being goods purchased for cash. This is called the narration. And here is a huge exam tip. Forgetting to write the narration is a classic mistake. Even if your numbers are flawless, examiners will absolutely dock your points if you leave that narration out. Don't do it.
Okay, Section 6. Recap and exam tips. We've covered a ton of ground today, from the history of Luca Pacioli to perfectly formatting journal entries. Let's do a rapid-fire review to lock this in.
Here are your major takeaways. First, remember the number 2. Every single transaction hits at least 2 accounts. Second, the fundamental equation. Assets will always equal liabilities plus capital. Third, when you face a transaction, identify the character first. Remember, people give and receive, real things come in and out, and nominal items are just bills for expenses and income. Once you know the character, apply the golden rule to find your debit and credit. And lastly, when you format your journal, never ever forget your narration.
So, I want to leave you with a quick challenge to test your new skills. Imagine you buy a business laptop for cash. Both the laptop and the cash are assets, meaning they're both real accounts. Using the golden rule for real accounts, debit what comes in, credit what goes out, can you figure out exactly how to write that journal entry? Think about it, write it out, and see if you can balance the equation. Once you master this entry, you literally have the exact key used to decode the financial statements of every Fortune 500 company in the world. Pretty cool, right? Thank you so much for joining me for this explainer, and keep practicing those golden rules.
Welcome to today's explainer. I am absolutely thrilled you're tuning in because today we are taking on a massive, honestly pretty empowering theme, order from chaos. We're going to demystify the absolute foundation of the accounting process, and then we'll break down one of the most revolutionary economic shifts in recent history, the goods and services tax, commonly known as GST. If you have ever felt completely overwhelmed by debits, credits, or just crazy complicated tax structures, well, you are definitely in the right place. So let's jump right in.
Okay, here's our roadmap for this explainer. Number 1, we'll look at the power of the journal. 2, the pre-GST tax nightmare. 3, how GST fixed everything. 4, mastering account classification. 5, crushing the accounting equation. And we'll wrap up with number 6, a final recap and some crucial exam tips.
Section 1, the power of the journal. I want you to think about this for a quick second. Imagine a really busy retail store, or maybe a massive manufacturing plant. Literally hundreds of things happen every single day. They're buying raw materials, selling products, paying rent, offering discounts, dealing with returns. It's a lot. And if every single transaction has two sides, kind of like an equal and opposite reaction in physics, how on earth do businesses track absolutely everything without losing their minds and descending into complete financial chaos? Well, the answer to that is the journal. This right here is the bedrock of accounting order. We call it the book of first or original entry. And it is so absolutely vital because it captures every single economic event exactly as it happens, right in the heat of the moment. We don't wait around to categorize it later. We record it chronologically, applying that brilliant double entry system where every debit has an equal credit. This is exactly where the chaos is first tamed. The advantages of this chronological system are just immense. Because everything is recorded in the exact order that it happens, you always have timely, up-to-date information. If you want to know what happened last Tuesday, you literally just go to last Tuesday in the journal. Crucially, it forms the foolproof basis for posting to the ledger later on, which massively reduces the chances of errors. But I really want to draw your attention to that second point on the list, narrations. A narration is a precise explanation written right under the entry. Without it, honestly, you just have a bunch of floating numbers. The narration is what tells the story of the transaction. Take a look at the entry dated the 30th here. We see a rent account debited for $50,000, a salaries account debited for $1 lakh, and a bank account credited for $1,50,000. But look right underneath those numbers, in the brackets. It says, being the amount paid for rent and salary. That right there is your narration. Think of the narration as the storyteller of the numbers. If an auditor comes back, say 3 years later, they don't have to guess what that outflow of $1,50,000 was for. The narration preserves the exact context. Order is maintained. Section 2, the pre-GST tax nightmare. So before the introduction of GST, the taxation system in India was incredibly fragmented. I mean, a real headache. You had multiple taxing authorities, the central government and state governments, levying a whole menu of completely different duties. You had excise duty on the manufacture of goods, state VAT on the sale of goods within a state, central sales tax for interstate sales, and service tax on services. Because these were collected by different authorities, it was virtually impossible to take the benefit of tax credits across the different stages. You were completely blocked from doing so. Let me show you the painful reality of this with a quick example. Imagine you're buying a new smartphone. The manufacturer's cost is 1 lakh rupees. The central government comes in and levies an 18% excise duty, which is 18,000 rupees. Now the trader gets the phone. Their new cost base isn't 1 lakh anymore, it's 1,18,000. When that trader goes to sell it to you, the state government levies VAT, let's say 18%, on that new inflated base of 1,18,000. Do you see what just happened there? The VAT was calculated not just on the goods, but on the excise duty as well. This is the dreaded cascading effect, a tax on a tax. It artificially inflated prices, resulting in an unjust enrichment completely at the cost of the ultimate consumer. It was absolute chaos. Section 3, how GST fixed everything. Enter the hero of our story, the Goods and Services Tax, or GST. It is a comprehensive indirect tax that essentially subsumed almost all of those messy, fragmented taxes we just talked about. Look at the stark difference between the two systems. We went from multiple competing authorities with zero cross-credits to a single unified tax stream. Now, the credit of taxes paid at previous stages is actually available as a set-off. So in our smartphone example, that initial $18,000 paid by the manufacturer becomes a credit the trader can use, meaning you never, ever pay a tax on a tax again. It's a game changer. The crucial point here is understanding these salient features, especially if you're facing an exam anytime soon. First off, it's levied on the supply of goods and services, so supply is the taxable event. Second, it's levied only on the value added at each stage. Third, and this is a really big one, it is a destination-based consumption tax. Here is a quick memory trick for you. The tax money travels to the final destination, meaning where the goods are actually consumed by the buyer, not where they were originally made. And most importantly, as we saw, it completely eliminates that cascading effect. It harmonizes the laws, bringing order to the entire country's tax system. Section 4, Mastering Account Classification. To keep a business truly organized, we must classify our accounts correctly. Traditionally, we split things up. Let's look at the main difference between real accounts and nominal accounts. Real accounts are permanent. A good memory trick? They are real physical things or lasting assets like land, buildings, and cash. These carry over year after year and they live on the balance sheet. Nominal accounts, on the other hand, are in name only. They represent temporary events like salaries, rent, or sales. Exam spotlight here, folks. Nominal accounts are temporary. At the end of the year, their net result, whether that's a profit or a loss, is transferred to the capital account, and then they are wiped completely clean to start fresh the very next year.
You know, you can actually classify the exact same account differently depending on whether you're using the traditional approach or the modern accounting equation approach. For instance, take rent outstanding. Traditionally, it represents the specific person you owe money to, so it's a personal account. But under the equation approach, it's simply classified as a liability because it focuses purely on the fact that you owe a debt. Look at sales. Traditionally, it's a nominal account because it is an income. Under the equation approach, we just call it revenue. It's the same reality, just viewed through different lenses of order.
Section 5. Crushing the accounting equation. Assets equal liabilities plus capital. Memorize it, internalize it. This equation must always balance. No matter how chaotic a business gets, no matter how many millions of transactions happen in a day, what the business owns, its assets, must equal what it owes to outsiders, its liabilities, plus what it owes to the owners, its capital. Why? Well, because of the business entity concept. The business is treated as a completely separate entity from its owner, so mathematically it owes that capital back to them. This formula right here is the mathematical gravity that holds the entire financial universe together.
Let's test that mathematical gravity by reverse engineering some missing amounts. Look at the first row here. If our total assets are 15 lakhs and our liabilities are 2,50,000, what must the capital be? It's just simple algebra. 15 lakhs minus 2,50,000 equals a capital of 12,50,000. Look at the second row. We don't know the assets, but we know liabilities are 1,50,000 and capital is 75,000. Just add them together, and our assets must be 2,25,000. The math flawlessly protects the equation every single time.
Section 6. Final recap and exam tips. Okay, let's lock in these final exam survival tips. Number 1. The journal is the book of original entry, not a secondary one. Number 2, and this is a massive mistake beginners make, so listen closely. Capital has a credit balance because it's a liability that the business owes to the owner. Number 3. For nominal accounts, all expenses and losses are debited, while incomes and gains are credited. Number 4. The balance sheet contains only personal and real accounts. Nominal accounts never ever go there. And finally, the fundamental purpose of GST is to prevent the cascading effect, completely eliminating that unjust tax on tax.
I want to leave you with a final thought to take out into the real world. You now know that every single economic event requires order. Every purchase has a debit and a credit. Every price tag you look at has a history of value-added tax that is now flowing logically, all thanks to GST. So, tomorrow, when you go to buy a coffee, or a book, or maybe that new smartphone, ask yourself, what accounts are being debited and credited behind the counter right now? How much of this price tag is the actual value, and how much is the destination-based consumption tax? Apply this logic, see the order hidden in the chaos, and I promise you'll never look at the economy the same way again. Thanks for learning with me on this explainer. Keep mastering the logic, and I'll catch you next time.
Hey everyone, welcome back to another explainer. Today, we're taking those big, complex accounting concepts and making them crystal clear, especially for those upcoming exams. Seriously, if you've ever stared at a massive, never-ending list of business transactions and thought, how on earth does anyone make sense of this? Well, you are definitely in the right place. Today, we are officially conquering the ledger. So let's just dive right into the core problem here. You see, a journal is fundamentally just a chaotic, chronological list of every single transaction a business makes. It's basically a diary. It tells you exactly what happened on Monday, then Tuesday, then Wednesday. But if I ask you right now, based only on that diary, exactly how much money a specific customer owes us, or exactly how much cash we have sitting in the bank, you'd literally have to manually hunt through hundreds of pages. No way, right? That is a terrible system for making business decisions. So the big question is, where do these journal entries go so they actually make sense? To solve this, we're going to walk through 5 steps today to completely master the ledger. First, an introduction to ledgers. Second, the anatomy of a ledger. Third, the rules of posting. Fourth, balancing the accounts. And finally, number 5, exam traps and practice. All right, let's kick things off with Section 1, Introduction to Ledgers, the ultimate sorting system. like I said, imagine your journal is a daily diary where every single thought is jotted down. This first section introduces the hero that steps in and organizes that messy diary into neat, easy-to-read folders. Here's the absolute crucial point you need to know. A ledger isn't just some supplementary, optional book. It's actually officially known as the Principal Book of Accounts. Basically, this is the big leagues. After transactions get recorded in the journal, they're classified and grouped right here. The ledger holds all your sets of accounts, whether we're talking personal accounts related to individuals, real accounts for your assets, or nominal accounts for your expenses and incomes. They all live here. And the main goal? To determine the specific account-wise balance for every single one of them. Now, take a really close look at the comparison on screen, because trust me, examiners absolutely love to test if you know the difference here. Journals are entirely chronological. They're just time-based. Ledgers, on the other hand, are analytical. They're account-based. You go to a ledger when you want to analyze a specific account, like your cash or maybe rent expense, completely independent of when those transactions actually happened.
Moving right along to Section 2, Anatomy of a Ledger, the T account. Let's see how this whole sorting system builds into the actual physical structure of a ledger page. If you were to open up this principal book, what are you actually looking at? Well, it brilliantly illustrates the classic T account shape. If you draw a line straight down the middle and another one across the top, it looks exactly like a giant letter T. It's split perfectly evenly. Actually, hold up your hands for a second. Your left hand represents the debit side, abbreviated as DR, and your right hand is the credit side, or CR. Notice how both sides have 4 identical columns. You've got the date, the particulars, where you write the opposite account's name, the JF, or journal folio column, which is just a page reference linking back to the journal, and finally, the amount.
Okay, Section 3, the rules of posting, moving the data. So we know what the folders look like, but how do we actually get the papers inside? Well, that process is called posting, which simply means transferring those debit and credit items from the journal into these specific ledger accounts. There's a very specific traditional procedure we have to follow here. First up, you have to open a separate, distinct account in the ledger for every single item you see in the journal. No mixing them up. Second, when you're posting a transaction on the debit side, remember, that's the left side, you always start your entry in the particulars column with the word to. And third, when you post on the credit side, the right side, you start with the word by. Here's a really quick memory trick for you. Debit and to are both short words, right? So they go together on the left. Credit and by. Wait, actually, scratch that. Let's just remember that debit and to go on the left, and credit and by go on the right. These words don't have some super deep mathematical meaning. It's honestly just standard practice. Now, I want you to literally burn this rule into your memory, because it's a fundamental law of the modern equation approach to accounting. The increase to an asset shall always be debited. Why? Because the original natural balance of an asset is always a debit. So when you get more cash or buy new machinery, you are posting that increase straight to the left side, the debit side of their respective ledger accounts. Which brings us to Section 4, balancing the accounts, finding the net result. Once all the posting is done for the month or the year, we have to figure out where we actually stand. We've got all these debits and credits sitting in the account, but what's the final number? Balancing is actually a really straightforward mathematical technique. You are simply finding the difference between the sum total of the debit side and the sum total of the credit side to figure out your net balance. That's it. You total up the left side, total up the right side, and find the gap between them. But keep in mind, what you do with that balance depends entirely on the type of account. Not everything carries forward to the next year. Nominal accounts, like your expenses and incomes, are completely closed out and their balances get transferred to the profit and loss account. Why do we do that? Because you want to calculate your profit fresh every single year. You don't want last year's rent expense messing up this year's numbers. However, real and personal accounts, like your assets, liabilities, and customer balances, those do carry forward to the next year. You'll actually see this noted in ledgers using balance CD, meaning carried down for the closing balance, and balance BD, meaning brought down for the new opening balance.
Okay, I need you to pay very close attention right here, because students lose marks on this constantly. It's totally counterintuitive. Let's say your debit side adds up to $10,000 and your credit side adds up to $8,000. The debit side is heavier, right? But to make the two columns visually equal at the bottom of the page, you have to temporarily write a 2,000 balancing figure on the credit side. Because students physically write this number on the credit side, they instinctively want to call it a credit balance. But the absolute rule is this: if the total debit side is greater than the total credit side, it is officially called a debit balance. Why? Because the debit side was the heavier side that actually generated that surplus. All right, let's jump into Section 5, Exam Traps and Practice. We're going to do a rapid-fire session to test your knowledge directly from the source material's practice questions. We want to make sure you are absolutely bulletproof for the exam. First, review these common student pitfalls carefully, because they are basically guaranteed to show up as tricky wording on your tests. Remember the flow of time. Transactions happen, they go into the diary, which is the journal, and then they are posted to the ledger folders. It is never the other way around. Also, cash is an asset, so it naturally has a debit balance. And remember our big comparison from earlier? Ledgers are for analysis, so they are analytical, not chronological. Let's test your memory on those end-of-year procedures we covered just a minute ago. True or false? At the end of the accounting year, all the nominal accounts of the ledger book are balanced. Take a second to really think about the specific wording here. Got your answer? Did you fall for it? The statement is actually false. While you do total them up, the correct terminology for nominal accounts, your incomes and expenses, is that they are totaled and entirely transferred to the profit and loss account to figure out if you made money this year. They are not merely balanced and carried forward the way assets are. Okay, here's a multiple choice question straight from the text. Think back to our step-by-step procedure slide to grab this really easy point. The process of transferring the debit and credit items from a journal to their respective accounts in the ledger is termed as what? A, B, or C? The answer is A. Posting is the correct terminology for migrating that daily journal diary data into our specific ledger folders using those to and by notations. Balancing is just what you do after the posting is completely finished. Let's do one more. This one tests your fundamental understanding of the modern equation approach to assets that we really highlighted earlier. True or false, cash account has a debit balance. This is absolutely true. Cash is an asset, and under the modern equation approach, assets will always naturally have a debit balance. This goes right back to that golden memory quote we talked about: always debit assets when they increase. Let's quickly recap everything we've built today. The ledger is your principal book, operating in an analytical order. Posting is the physical action of moving data from the journal to the ledger. When you post, you use to on the debit side and by on the credit side. And finally, balancing is simply finding the net difference between those two sides, making sure to remember that the heavier side dictates the name of the final balance. We have successfully organized the chaos of the journal into neat, analytical ledger accounts. But that leaves us with one final pretty exciting question for our next explainer. What if we made a math error while doing all this transferring? How do we mathematically prove all these debit and credit balances are entirely correct before we go and build our final financial statements? Think on that, and I'll see you in the next explainer to uncover the answer. Welcome to this explainer. Today, we're going to meet the ultimate checkpoint in the entire accounting process. Now, whether you're trying to figure out your family budget, running a brand new startup, or studying for those really tough professional financial exams, keeping track of money is a big deal. But there is a massive, massive step between just recording your daily receipts and actually printing out that final official profit report. Think about the fundamental problem here: human error. I mean, over the course of a month or a year, a business might enter thousands and thousands of transactions. So how do accountants actually know their math is right before they present their final reports to investors or to the government? They definitely don't just cross their fingers and hope for the best. Instead, they use a vital mathematical checkpoint, and that is known as the trial balance. To help you master this, here is our roadmap for today. Number 1, meet the checkpoint. Number 2, the golden rules. Number 3, the 3 methods. Number 4, the blind spots. And finally, number 5, exam practice and suspense. Let's jump right in. Starting off with Section 1, Meet the Checkpoint, where we'll focus on really understanding the trial balance. You see, accounting is basically a chronological cycle. Phase 1 is journalizing, literally just writing down transactions as they happen in real time. Phase 2 is posting those entries into individual ledger accounts, which means you group all the cash stuff together, all the rent stuff together, and so on. Now, the trial balance is the absolutely crucial third phase. It acts as the bridge. You literally cannot move to phase 4, which is creating those final profit and loss and balance sheets, without passing through this checkpoint first. So, what is it exactly? Well, a trial balance is a statement prepared on a particular date showing separately the debit and credit balances to check arithmetical accuracy. Now, the absolutely key word I want you to focus on here is statement. It is a statement, not an account itself. It's really just a list, a summary drawn up to verify that for every single debit you recorded, an equal credit was also recorded, keeping the whole double entry system perfectly balanced. We prepared this statement for 3 main objectives. First up, to establish that arithmetical accuracy, basically just proving that our addition and subtraction are correct. Second, to form the basis for our financial statements. If you don't have an agreed upon trial balance, your final statements simply won't show a true and fair picture of the business, period. And third, it serves as a highly efficient summary of the ledger. Imagine a manager suddenly asks, hey, how much do we owe our suppliers? You don't need to dig through hundreds of ledger pages. You just glance at your nice one-page trial balance.
Moving right along to Section 2, the golden rules, focusing on layout and logic.
The physical layout here is incredibly simple, so don't let it intimidate you. It consists of just 4 columns. First, you've got the serial number. Second is the name of the ledger account, like cash or rent. Third is the debit amount column. And fourth is the credit amount column. It's also always prepared as of a specific date, which sits right at the very top of the statement, exactly like a timestamp for your financial data. So here is the crucial point. Where do the numbers actually go? Well, it all comes down to the nature of the account itself. To remember this, I want you to use this amazing memory trick. Dead click. Let me spell that out. DEAD, debit expenses, assets, and drawings, which also includes debtors. CLIC, credit, liabilities, income, and capital. Seriously, memorize this trick and you have basically won half the battle. But watch out for this trap. Examiners absolutely love to test your conceptual clarity right here. Purchases are an expense, so naturally they're a debit. But a purchase's return is treated the exact opposite way, because assets are going out of the business, so it actually has a credit balance. Similarly, sales bring in income, so they're a credit. But a sales return means assets are coming back in, so it takes a debit balance. Please don't let these reverse relationships trip you up. All right, on to Section 3, the 3 methods. We'll look at total, balance, and combined. This perfectly illustrates the difference between the first 2 techniques. In the total method, you take the entire sum of the debit side of a ledger and the entire sum of the credit side, and you bring both of those big numbers over. But the balance method, which, by the way, is the most commonly used in the real world, only brings over the final netted amount. So say you had $10,000 in cash, but you spent $2,500. The balance method just reports that remaining $7,500 debit balance. It's just so much cleaner for preparing your final statements. Now, there is also a third approach, quite cleverly named the total and balance method. This one simply extends the statement to include columns for both. You get to see the raw totals and the netted balances right there side by side. It offers ultimate thoroughness, even though, it takes a bit more time to draft up. Let's pivot to Section 4, the blind spots or the limitations of the trial balance. Here's the scary part. There are specific errors that will bypass this checkpoint completely. These include total omission, where you just completely forgot to record a transaction at all, or writing the wrong amount in both columns. I mean, if you bought a desk for $500 but accidentally recorded it as $50 on both sides, the math is technically still going to balance. Other hidden errors include using the wrong account, failing to post an entry to the ledger entirely, or just accidentally posting the exact same entry twice. A really great way to remember this is what I call the spell checker analogy. A trial balance is exactly like the spell checker on your word processor. It will absolutely catch bad math, just like a spell checker catches a misspelled word. But if you type the word there instead of there, the spell checker just ignores it because, hey, it's technically a valid word. Similarly, if you record a massive machinery purchase as just a regular day-to-day business expense, you've committed an error of principle. The trial balance columns will still match perfectly, but your underlying accounting logic is entirely wrong. Finally, Section 5, Exam Practice and Suspense. What actually happens when things don't add up? Let's apply our knowledge to a practical scenario to see what happens when the totals stubbornly disagree. We're tasked with correcting an inexperienced bookkeeper's work, and we immediately see some fundamental errors. We have to apply our golden rules here. They put a bank overdraft on the debit side,
But an overdraft is a liability. We owe the bank money, so it must be moved to the credit side. They credited discount allowed, but that's an expense to the business, so it actually belongs on the debit side. And a provision for doubtful debts is a liability against potential future losses, so that must shift to the credit side too.
But here's where it gets highly practical. Even after we meticulously fix all of the bookkeeper's category mistakes, we sum up the columns and they still don't match. We are dramatically short by exactly 1,175 on the debit side. So what do? We can't just stop the entire accounting process for the whole company. Enter the suspense account. It is a temporary holding zone. We literally just plug that missing 1,175 into a debit suspense account just to force the trial balance to tally. This allows us to temporarily proceed to our final accounts. But remember, it is strictly a temporary fix. The accountant must now put on their detective hat, dig all the way back through the ledgers to find that missing money, clear out the suspense account, and ensure true accuracy. And that brings us to the end of our journey today. Let's do a really quick recap. The trial balance is our vital third-step bridge that checks our arithmetical accuracy. Remember our dead-click memory trick for sorting your debits and credits? And never forget that hidden errors of principle can still sneak right past your mathematical spell checker. And if things just don't add up, your suspense account is your temporary detective's holding zone. A tallied trial balance gives you great confidence in your math for sure, but true accuracy requires constant vigilance. So, as you move forward in your studies or your business, I want you to ask yourself, are your underlying principles as perfectly balanced as your columns? Thanks so much for joining me on this explainer. Keep learning and keep balancing. All right, let's dive right into this explainer and demystify what I like to call the organizational heroes of the accounting world, subsidiary books. If you've ever looked at a massive, chaotic list of business transactions and just felt an immediate wave of panic, well, you are in exactly the right place. Today, we're taking all that disorganized, raw accounting data and turning it into a perfectly structured, totally stress-free system. Here's our quick roadmap for today. We'll be hitting the accounting inbox problem, principal versus subsidiary books, meeting the books themselves, walking through the M/Narain example, handling purchase returns, and finishing up with a recap and some solid exam tricks. Okay, Section 1, the accounting inbox problem. So let's start with a quick thought experiment to understand exactly why the system even exists, because, understanding the why is the best way to never forget the how. I want you to imagine you're running a super busy store. Every single time a customer buys something, every time you pay a supplier, every time a dollar moves, you just write it down in one endless chronological list. Think of the general journal like one giant chaotic email inbox. Without a way to sort it, you would be totally lost trying to figure out your total sales for the week or how much you owe your vendors. Honestly, it's an accountant's worst nightmare. This is where we solve the inbox problem. By creating specific folders or registers for different types of transactions, we fix the chaos. We call these registers books of original entry or prime entry. So instead of jamming a credit sale into a massive general journal, you log it directly into a dedicated sales book. You literally skip the messy journal entry entirely and group similar items together right from the start. Moving on to Section 2, Principal versus Subsidiary Books. Now, how we classify these books is incredibly important because not all accounting books are created equal. Here is a fantastic memory trick for your exams. Think of the principal books as the VIPs and the subsidiary books as the assistants who sort the data for them. The VIPs are your main destinations, right? That's the ledger and the cash book. They hold the final official balances. But the subsidiary books, like your purchases, sales, and returns books, they're the hardworking assistants. They catch the raw data, organize it by category, and prep it so it can be cleanly handed off to the VIPs later. And this dynamic perfectly illustrates the English system, which is also known as the practical system of bookkeeping. Now, a massive misconception a lot of students have is that using these specialized assistant books somehow breaks the fundamental rules of accounting. It absolutely does not. It just optimizes them for efficiency. You are still obeying every single rule of the double entry system. You're just organizing the initial paperwork so much better before posting it to the ledger. All right, Section 3, meet the subsidiary books. It's time to meet the team. This table right here, this is your ultimate cheat sheet for matching the exact transaction to its proper subsidiary basket. Notice how incredibly specific these are? The purchases book is strictly for credit purchases of goods, not cash, and definitely not assets like a delivery van, just credit goods. And the exact same logic applies to the sales book, only credit sales of goods. If cash is involved, boom, it goes to the cash book. But what if a transaction is just weird and doesn't fit into any of these neat little assistant folders, like, say, buying an office computer on credit? Well, that gets dumped into the final catch-all basket, the journal proper.
And honestly, by mastering these different books, you aren't just memorizing definitions. You are hitting the core learning outcomes expected on pretty much every major accounting exam. From recording transactions correctly to distinguishing your VIPs from your assistants and knowing exactly when you still actually need to use a standard journal entry.
I always like to visualize these books as taking a giant, overwhelming pie of data and neatly slicing it up. Suddenly, instead of one massive mess, you have clean, manageable slices that are super easy to digest and post to the ledger.
Let's see this in action. Section 4, the M/Narain example.
Okay, let's put on our accountant hats for a second and look at a real-world application with the M/Narain & Company illustration. We have a mix of cash, credit, goods, and asset purchases here. This is a classic textbook exam scenario designed specifically to test your sorting skills. We need to figure out which of these 4 transactions actually belong in the purchases book. Taking a step-by-step approach is absolutely crucial here. Look at February 1st. They bought goods on credit. Does it go in the purchases book? Yes, it does, but we have to calculate the gross value first. 5 gross pencils at 100 rupees each, plus 1 gross register at 240 rupees per dozen. You do that math to get your gross total. Now, what about February 2nd? They bought goods, sure, but for cash. Stop right there. Cash transactions go straight to the cash book. February 3rd, they bought a computer on credit. A computer is an asset, not trade goods, so that goes to the catch-all journal proper. Finally, February 4th, a credit purchase of paper. That goes straight into the purchases book. See how cleanly those sorting rules apply? All right, major red flag here. Listen closely, because this is where students lose silly marks all the time. The trade discount must be stripped out before the final number ever hits the book. Going back to that February 1st transaction with Brown & Co., we had our total gross value, but they gave us a 10% trade discount. That 10% discount is not recorded as its own separate journal entry. It just instantly reduces your initial purchase cost. So you calculate the total, subtract that 10%, and only record the net amount into your purchases book. Trade discounts never get their own ledger account. Remember that, and I guarantee you'll save yourself crucial points on test day. Moving right along to Section 5, handling purchase returns. Sometimes things don't go as planned, right? Goods arrive damaged, or it's just the wrong item entirely. That's where the returns outward book comes in, also known as the purchase returns book. The rules for this book are completely identical to the purchases book, just moving in the exact opposite direction. You're sending goods outward from your warehouse back to the supplier. You use the exact same formatting and logic here that you used when you originally bought the goods. But definitely take note of this specific exception rule direct from our source material. If a business rarely returns items, they can skip opening this specific subsidiary book entirely and just use the journal proper. At the end of the day, accounting is all about practicality. If you only return 1 item a year, there's absolutely no need to buy a whole separate physical book or set up a dedicated digital register for it. Just journalize it and move on. And finally, Section 6, Recap and Exam Tricks. Let's lock this all into your fast recall memory. Keep these 5 points in your mental back pocket, and you will absolutely breeze through any conceptual question on this topic. Number 1, you are just sorting transactions into the right folders before sending them to the ledger. 2, principal books are the VIPs, subsidiary books are the assistants. 3, the English system follows all the normal double entry rules. 4, credit goods go to the purchases or sales books, cash goes to the cash book, and assets or oddities go to the journal proper. And 5, always take out that trade discount first. By utilizing these books of prime entry, you've taken disorganized, raw data and structured it beautifully. What used to be a terrifying, chaotic inbox is now a perfectly categorized filing system. But I want to leave you with a bit of a provocative thought to chew on. We've collected all this beautiful, perfectly sorted data in our assistant books, but how do those assistants actually hand the data over to the VIP ledger? What does that process actually look like? Well, that is the very next step in the accounting cycle. Until next time, keep learning, and thanks so much for checking out this explainer.
All right, let's dive right into this explainer. Now, if you're studying accounting, you've probably realized by now that there is just a whole lot of data entry. But what if I told you there's this ultimate dual identity tool that will not only save you a ton of precious time, but also rack up your exam marks? Today, we are mastering the cash book. You can basically think of it as accounting's secret superhero, swooping in to rescue you from maintaining duplicate ledgers. So right out of the gate, let's pose a classic beginner trap question. You will absolutely see this on a test at some point. Is the cash book a journal where we first record transactions, or is it a ledger where we classify and balance those accounts? Most people guess one or the other, but spoiler alert, they're wrong. See, the secret identity of the cash book is that it's actually uniquely both. Normally, you'd enter a transaction into a subsidiary book, like a journal of original entry, and then you'd have to physically copy that over to a principal book, the ledger. But with the cash book, cash transactions are straight away recorded right there, and the balances go directly to your trial balance. It serves as both a subsidiary book and a principal book. It literally eliminates the entire need to maintain a separate cash account in your ledger. Talk about efficiency, right? Here is our game plan for today. We're covering the cash book's dual identity, the simple cash book, 2-column and discounts, 3-column and contra entries, petty cash, and the impress system, and we'll wrap it all up with an ultimate exam recap. Okay, level 1, the simple cash book. Let's see how this builds the absolute foundation of tracking money. The golden rule here is incredibly simple. Debit what comes in and credit what goes out. A quick memory trick for you. Debit and deposit both start with D. Credit is what clears out. Whenever cash enters the business, boom, you write it on the left-hand side, the debit side. And whenever cash leaves the business, say for rent, salaries, or buying furniture, you write it on the right-hand side, the credit side.
To put that into perspective, imagine a real business month. We start on January 1st with an opening balance of $1,200. Throughout the month, we get receipts from ROM and from sales, which we just add to the left side. Then, on the right side, we record our payments, rent, a payment to Sham, furniture, and salaries. To find our closing balance, it's just simple math. Total up the receipt side, which is $1,800, and subtract all those payments. The difference? $770. We write buy balance CD for carry down on the credit side to make both sides balance out perfectly at $1,800. And that $770 just becomes the opening balance for the very next month.
When you actually draw this out, the standard textbook layout features these identical, beautifully symmetrical columns on both the debit and credit sides. You've got date, particulars, which is just where you write the name of the corresponding account, LF, standing for ledger folio so you can cross-reference your accounts, and, of course, the amount column. Moving right along to level 2, the 2-column book and discounts. As businesses grow, transactions naturally get a bit more complex, and that's when we introduce cash discounts. So what is a cash discount really? Well, it's basically an allowance made for prompt payment. Imagine a customer owes you $500, but you tell them, hey, if you pay me right now, today, you can just give me $490, and we'll call the whole thing even. The cash you actually receive is $490. That $10 difference, that's the cash discount. For you, the one receiving the payment, that discount is technically a loss, but for the person making the payment, it's a gain. Because these discounts are so tightly tied to cash payments, accountants conveniently just added a cash column right next to the cash column. Now listen closely, because this is a massive trap where students always lose marks. It's absolutely crucial you get how we treat these new discount columns. Discount columns are strictly memorandum columns. You total them at the end of the month, but, and I can't stress this enough, you never balance them against each other. Actually, scratch that. You just total them. That's it. You take the total of the discount allowed column and debit it to the discount allowed account in the ledger. Then take the total of the discount received column and credit it to the discount received account.
So in a 2-column layout, when you pay someone, let's say MS Rayton & Co., you credit the cash going out, and right next to it, you record the discount you receive from them. The person you pay is debited in their own ledger, with both the cash paid and the discount allowed. It just keeps the whole shebang incredibly neat and easy to track.
Which brings us to level 3, the 3-column book and contra entries.
Because modern businesses don't exactly keep thousands of dollars stuffed under a mattress, we use a bank column. And this introduces a really fascinating accounting mirror effect called a contra entry. Think of C for crossing out. It's essentially money moving from your left pocket to your right pocket. When you deposit cash into the bank, what happens? Cash goes out of your physical business, so you credit the cash column. But the bank is the receiver, right? So you debit the bank column.
The transaction crosses itself out entirely within the cash book. To flag this, we put a big, bold C in the LF column on both sides.
Now with the bank column, we get a brand new possibility, the overdraft. Physical cash can never be negative, right? I mean, you can't spend money you don't literally have in your hands. But a bank? A bank can allow you to withdraw more than you've deposited. A normal, favorable bank balance will show up as a debit balance, just like cash. But if you dip into an overdraft, your payments exceed your receipts, and the bank column will suddenly show a credit balance.
When you have all three columns, discount, cash, and bank, working together in perfect harmony, you'll see those contra entries marked with a C. Anywhere cash was, say, withdrawn from the bank for office use. Debit cash, credit bank. It gives the accountant an absolute eagle-eye view of all liquidity in one single, unified book.
All right, level 4, petty cash and the impress system.
To handle the logistical nightmare of recording tiny, everyday expenses, things like bus fares, postage stamps, or grabbing a quick coffee for a client, we use petty cash. You definitely don't want to clutter up your main 3-column cash book with $3 transactions. Petty cash is usually run on something called the impressed system. I always like to explain this using a water tank analogy. Imagine a tank with a float valve set at exactly $100. Over the week, the petty cashier drains some water out, say spending $42 on various small things supported by receipts. At the end of the period, the main cashier refills the tank with exactly $42. Boom, the float is perfectly back to $100.
And to keep track of where those small drips of money are actually going, the petty cashier uses analytical columns. Instead of just vaguely writing payment, they record the total amount and then break that amount out into specific categories like postage, stationery, or traveling.
The whole petty cash cycle flows so logically. The opening balance sits on the receipt side, followed by a list of small payments neatly categorized into their columns. At the end of the period, the total of those payments is calculated. The main cashier then writes a single check for that exact total to reimburse the petty cash fund, restoring the impressed balance for the next period. At the end of the month, only the totals of those analysis columns are posted to the main ledger. This saves a massive amount of bookkeeping time.
Finally, level 5, the ultimate exam recap.
Let's do a rapid-fire review to lock these memory anchors in for your exams. Master these and you are golden. These are the highest yield rules straight from the source material. Number 1, the cash book is both a subsidiary and principal book. True. Number 2, the discount column is never balanced. True, just total it. Number 3, a contra entry requires a C in the folio column. True. Number 4, a credit opening balance in the bank column means an overdraft. True. And number 5, the cash book records credit transactions. False. No way. It records only cash transactions. If you buy something on credit, it goes nowhere near the cash book until the day you actually pay for it.
I really want to cement this golden rule of the simple cash book in your mind. The total of the receipts column is always greater than or equal to the total of the payments column. Why? Because as we said, you can never have a negative physical cash balance. You physically cannot spend cash that does not exist in your drawer. So if your simple cash column ever shows a credit balance, stop. You've made a math error. Well, we've covered a ton of ground today, from the dual identity of the cash book all the way to managing petty cash flows. But I'm going to leave you with a bit of a provocative question to test your broader accounting knowledge. We know cash discounts go in the 2 or 3 column cash book to reward prompt payment, right? But what about trade discounts, those bulk discounts given right at the point of sale? If they aren't recorded in the cash book, where exactly do they go in the accounting cycle? Or are they recorded at all? Think about that as you prepare for your next accounting adventure. Until then, keep those ledgers balanced.
Okay, let's dive right into this explainer. Today, we're going to turn you into an accounting detective to solve what is basically the ultimate financial mystery, a mismatched trial balance. Have you ever tried balancing your own checkbook, or maybe looked at a family budget and realized the numbers just don't add up? Well, in accounting, when your total debits simply do not match your total credits, it means a crime against the books has been committed. So today, we're going to learn exactly how to hunt down these elusive errors, categorize them, and most importantly, fix them using professional, airtight accounting techniques. Right off the bat, the absolute most crucial point you need to understand is the golden rule of accounting. We literally never just use an eraser or correction fluid to hide a mistake. No way. Why? Well, because accounting relies entirely on a clear, transparent audit trail. If you just cross out a number, an auditor or, say, your manager has absolutely no idea what happened or who changed it. Instead, we have to use precise rectification entries. We fix mistakes by adding new, corrective journal entries that mathematically neutralize the error and establish the truth. It's kind of like performing financial surgery. So here is our investigation syllabus for today. First, spotting the errors, then the 4 main types of errors, their impact on the trial balance, how to fix them directly, how to use the suspense account, and finally, some key exam tricks and a quick recap.
Okay, Section 1, Spotting Accounting Errors. Where exactly did things go wrong? So if your trial balance is off, you're going to want to follow these exact steps. First, simply check your totals. I mean, it might just be a basic addition mistake, right? Next, check if the opening balances from the previous year were actually brought forward correctly. Now, here is an absolutely brilliant trick you should always look out for. Have the difference. Think about it. If your trial balance is off by exactly 500, go look for a 250 transaction. Why? Because if you accidentally post a 250 debit as a 250 credit, it creates a 500 gap. It's a lifesaver. Finally, if all else fails, you've just got to do a complete audit of all nominal accounts, tracing every single entry back to the subsidiary books.
Moving on to Section 2, the 4 error types. These are our usual suspects. For your exams, you can easily memorize these culprits using a really simple trick. Just remember the acronym POCC. Let's interrogate each one of them.
Our first suspect is the error of principle. Now, this isn't just a simple typo. This is a fundamental, rule-breaking error. This happens when someone completely ignores basic accounting concepts. For example, imagine charging the purchase of a brand new, long-term asset, like a typewriter, to everyday office expenses. This is super dangerous because it artificially lowers your reported profit for the year and completely hides assets from your balance sheet. The numbers might technically add up, but the financial story you're telling is completely wrong.
Next up is the error of omission. This is the invisible suspect. It happens when a transaction is just completely forgotten. Imagine a customer returns goods to your store. You put them back on the shelf, but someone completely forgets to record the return in the books. Or maybe you make a sale and the paperwork literally falls behind a desk. Because there is neither a debit nor a credit recorded, your books are going to remain perfectly balanced, but they're going to be entirely incomplete.
Then we have the error of commission. This suspect commits crimes through sheer clumsiness or basic clerical oversight. It's your classic typo. For instance, accidentally writing a $17,270 purchase as $17,720 in the purchases daybook. Or maybe you correctly recorded a sale, but you ended up posting it to the completely wrong customer's account. See, it's an error of execution, not a misunderstanding of accounting theory.
Finally, we have compensating errors. Now, these are incredibly sneaky because 2 wrongs seemingly make a right. Imagine your trial balance looks perfectly balanced, but underneath it all, a 10 rupee missed credit perfectly hides behind a 10 rupee excess debit in a completely unrelated account. The errors literally compensate for each other. Uncovering these usually requires a deep, highly detailed audit because the trial balance is giving you a completely false sense of security.
All right, Section 3, impact on the trial balance. Does it actually agree or not?
This is a really critical takeaway for your exams. You need to know exactly when the trial balance will actually warn you. Surprisingly, it agrees, meaning it won't warn you at all if you commit an error of principle, a complete omission, or a compensating error, because in all of these specific cases, equal debits and credits were either recorded or completely missed. However, the trial balance disagrees when you make a one-sided error. We're talking things like wrong castings, which just means wrong totaling of a book, partial omissions, where you post a debit but totally forget the credit, or posting something to the wrong side of an account.
Let's move to Section 4, fixing errors directly. This is where we use rectification entries. Okay, let's look at a classic error of principle from our case files, where a fixed asset was accidentally treated as a basic revenue expense. The accountant bought a typewriter for $700, but mistakenly logged it straight into office expenses instead of a proper fixed asset account. So how do we fix it? Well, we debit the furniture account for $700. That brings the asset to life on our balance sheet, right where it belongs. Then we credit the office expenses account for $700. Since expenses normally have a debit balance, crediting it acts as a subtraction. That effectively kills the mistake and pulls that $700 right out of expenses. And just like that, balance is perfectly restored without a single eraser mark. Now, let's consider this one-sided error of commission, where the purchases book was simply added up short by 100 rupees. In accounting speak, this is an undercasting error. It literally just means the purchases account in the ledger received 100 too little. Now, because it's a one-sided error, and let's assume we caught it early, like before the trial balance was closed, we actually don't need a full double-entry journal to fix it. We can just go directly into the purchases account ledger, hop over to the debit side, and write an adjustment. To undercasting of purchases book, 100. We're basically just manually adding the missing weight right onto the scale.
All right, Section 5, using the suspense account. Think of this as our temporary parking lot.
Picture this stressful scenario. It's year end. Your trial balance is off by thousands. You've got a one-sided error that's breaking the balance, but management, or maybe the bank, needs the financial statements literally today. You absolutely do not have time to do a full audit. So how do you force the books to balance legally and transparently? The answer? You open a suspense account. This is a temporary parking lot for your missing numbers. If your debit column is lighter than your credit column by, say, 582, you just put a debit entry of 582 right into the suspense account to force them to match. Now, a massive exam tip here, and this is where so many students lose marks. Always remember that the opening balance of the suspense account must equal the exact difference in your trial balance. Now, take a look at this incredibly tricky double impact error. We bought goods on credit, which means we owe our supplier, Gupta & Co., some money, so their account should naturally have a credit balance of 250. Instead, our clumsy accountant debited Gupta & Co. 250, making it look like they actually owe us. This is that have the difference concept we talked about, just in reverse. By swinging from a positive 250 to a negative 250, the ledger now has a massive 500-unit gap. To fix this using our suspense account, we've got to hit Gupta & Co. with a massive 500 credit. Why? Well, the first 250 of that credit simply cancels out the wrong debit, bringing the account to zero. The second 250 then correctly records the actual purchase. Because this was a one-sided posting error that we found after closing the trial balance, we debit the suspense account by 500 to absorb the shock of this one-sided correction. Over time, as you play detective and fix all these one-sided errors, that suspense account will naturally drain right back down to exactly zero. Which brings us to Section 6, Exam Tricks and Recap. Let's do a fast final review to lock this all in. Okay, keep these core facts locked in your memory for exam day. First, never overwrite, always rectify with proper entries. Second, remember the suspects, POCC, principal, omission, commission, compensating. Third, remember that principal and compensating errors are the stealthy ones. They do absolutely nothing to affect the trial balance. And finally, always, always anchor your suspense account opening balance to the exact trial balance difference. Got it? So here's a question to leave you with as you practice your own rectification entries. If a balanced trial balance doesn't actually mean a perfect set of books, but just means debits equal credits, what kind of detective work will you need to uncover those hidden errors? You really have to understand the core business reality behind the numbers to spot an error of principle or omission. So review your basic concepts, trust the process we outlined today, and until next time, keep your books balanced and your investigative skills sharp.
Hey everyone, and welcome to this explainer. Today we're doing something a little bit different. We're throwing on our trench coats, grabbing our magnifying glasses, and stepping right into the shoes of a financial detective. We are going to solve the ultimate mystery. What exactly happens when a company's accounting records are totally broken, and more importantly, how do we fix them?
So, imagine the situation. You're at the very end of the accounting period. You run your trial balance, which, is essentially the ultimate financial lie detector test for a business. The total debits are supposed to equal the total credits perfectly. But suddenly, the test fails. The numbers flash red. They just don't match. So what do? Just panic? Throw the entire ledger out the window? No way. You investigate.
Here is our investigative roadmap for today. 1. When trial balances fail. 2. 4 types of accounting errors. 3. Enter the suspense account. 4. Fixing errors next year. 5. Impact on net profit. And 6. Final recap and exam tips.
Section 1. When trial balances fail. Okay, let's dive right into this. When a trial balance fails, it's basically screaming at us that somewhere in those ledgers, clues are hiding. Real errors have been made, and they're just waiting to be discovered. In our source files, we actually have a real case study involving the books of a Mr. Dutt. His trial balance was out of whack by exactly $493 in excess credit. That single glaring out-of-balance number, that's our trigger. It tells us our debits and credits are misaligned, and it kicks off our entire investigation.
And this brilliantly illustrates what a real-world error log actually looks like.
Think of this as the actual case file for Mr. Dutt. We've got some fascinating clues here. An unrecorded 100 rupee cash receipt, an undercasted returns book, a purchase of an office table wrongly passed through the purchase's daybook. These aren't just, random, careless mistakes. They are very specific accounting crimes that we need to categorize and solve.
Section 2. 4 types of accounting errors.
To solve these accounting crimes, we got to know exactly who we're looking for. So let's move to our suspect lineup and identify the 4 main categories of accounting mistakes. Meet the POCCS suspects. By the way, this is a fantastic memory trick for your exams. P stands for errors of principle. This is when a fundamental accounting rule is just straight up broken, like treating a long-term asset purchase as an everyday expense. O is for omission, where a transaction is completely or maybe partially forgotten, just never recorded. C stands for commission, which basically means clerical errors, writing the wrong amount, posting to the wrong side, or totaling a book incorrectly. And the final C is for compensating errors. This is wild. It's where 2 totally different mistakes coincidentally cancel each other out, hiding perfectly within a balanced trial balance. So the crucial point is perfectly captured in this comparison from our case files. Mr. Dutt paid $375 to workmen for making showcases. Now, a showcase is an asset, right? It's furniture, but it was wrongly charged to the wages account as a standard everyday expense. This is a textbook error of principle. The rule is that cost to build an asset must be capitalized. So to rectify this, we have to strip it out of wages and place it exactly where it belongs, the furniture account.
Section 3. Enter the suspense account. But wait, what happens when we know the trial balance is off by that $493, but we haven't actually found the errors yet? We can't just grind the whole business to a halt. We need a holding cell. Enter the suspense account. I want you to think of this as a temporary waiting room. If your credits are too high, you debit the suspense account to artificially force the trial balance to agree. It just holds the difference so the company can go ahead and prepare its draft financial statements, while you, the financial detective, do the heavy lifting behind the scenes to find the real culprits.
Now, the timing of when you actually discover an error changes literally everything, and this is a highly, highly testable concept. If you catch a one-sided error before the trial balance is made, you don't even need a formal journal entry. You just cross it out and adjust the account side directly. But if you catch it after the trial balance fails, you absolutely must use that suspense account to balance your rectification entry. And what if you don't find it until the next accounting year? Well, that requires a completely different procedure entirely.
Before we jump into next year's procedure, I want to give you the golden mental logic for fixing any error. Please, don't just blindly memorize journal entries. Ask yourself these 3 simple questions. First, what should have happened? Like, what was the correct entry supposed to be? Second, what did happen? What exact mistake was made? And third, how do we fix it? You just compare the 2, reverse the wrong parts, and insert the right parts. It's pure, beautiful logic.
Section 4. Fixing errors next year.
Let's move on and see how this logic builds into handling cold cases. What happens when an error from, say, 2022 isn't discovered until 2023? There is a massive warning directly from our source material about this. If you missed a 1,000 rupee purchase in 2022 and you just casually add it to the purchases account in 2023, you are artificially jacking up 2023's expenses. This will, as the text explicitly says, falsify the current year's profit. It makes 2023 look way less profitable than it actually is simply because it's carrying the burden of last year's mistake. We can't have that.
So, to avoid falsifying our profits, we use this specific next year correction protocol. Step 1, instead of using normal expense or income accounts, which we call nominal accounts, we open a special profit and loss adjustment account specifically for these prior period items. Step 2, we pass our rectifying entry using this special account. And step 3, listen up because this is a major exam alert for you. You absolutely must transfer the final balance of this P&L adjustment account directly to the owner's capital account. If you forget step 3, your case essentially remains unsolved and you are going to lose vital marks on exam day.
Section 5. Impact on net profit.
All right, so we know how to fix the mechanics, but let's talk about the real-world consequences here. How do these errors actually affect a business's bottom line? Let's run through the practical math. If your expenses were overcast, meaning they were accidentally added up to be 50 rupees too high, your reported profit was artificially lowered. So when you fix it by crediting those expenses to reduce them back down, your net profit actually increases by 50. Similarly, if your sales were totaled short by 100, fixing it means recording more sales, which directly increases your profit by 100. It's a teeter-totter effect. Every single rectification of an income or expense account causes a direct ripple effect on the final net profit of the business. Section 6. Final recap and exam tips.
Wow, okay, we have gathered the evidence, we've interviewed the suspects, and we have solved the accounting crimes. Let's bring this investigation to a triumphant close with a rapid-fire revision of our absolute most critical evidence. Here is your case closed checklist. I want you to lock these into your memory. First, use the POC mnemonic to remember the 4 error types: principal, omission, commission, and compensating. Next, remember that the suspense account is just a temporary holding cell for one-sided errors after the trial balance is drafted. If you're fixing a cold case in the next accounting year, use the profit and loss adjustment account for all expenses and incomes so you don't falsify current profits. And always transfer that P&L adjustment balance to capital to close the case for good.
You now have the exact tools, the logic, and the protocols used by the very best financial detectives to rectify any accounting error that comes your way. So the next time you see a trial balance fail, you no longer need to panic. You just need to investigate. Look at your ledgers, trust your 3-step rule, and ask yourself, are you ready to crack the case on your next accounting exam? Because I promise you, the clues are right there, just waiting for you to find them.